Welcome to Get Rich Education. I'm your host, Keith Weinhold. As we tilt into a new year, a special guest and I have each attended different conferences over the last few weeks, helping to shape our collective take on real estate affordability, interest rates, inflation, and the flow of institutional money into real estate. We're going to share how this all impacts your financial future today on Get Rich Education. MC Laubscher is the host of the Cash Flow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit PassiveRealEstateGuide.com and get your free copy today. That's PassiveRealEstateGuide.com.
Get Rich Education is brought to you by Ridge Lending Group, Producers Wealth, Norada Real Estate, and Total Control Financial.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Athens, Greece to Athens, Georgia, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education, and we're discussing current events in real estate investing today. Real estate economies are complex, and I'm here to help simplify them for you. So often, a new factor for you as an investor, say the introduction of heightened tariffs, which is basically a trade tax, will impose a number of push-pull factors on you, both positives and negatives. First, macroeconomically, I contend that tariffs are bad for you. It impairs the ability for two or more parties to equal out their supply and demand imbalances. Let's say you've got 100 widgets and 0 bags of groceries. Well, you will make it a habit to form a relationship with a trade partner so that you can trade away your widgets and get the groceries that you need, or else you are going to die of starvation because you can't eat widgets. But now things change. A new tariff effectively channels a moat, a mile wide and a mile deep between you and your trading partner. You can still trade, but this vast moat, this makes the cost of your incoming groceries 25% higher, while your trade partner had to pay 25% more for the widgets over on their side. But the 25% higher price you each had to pay, that doesn't go to you and your trading partner. That extra goes to governments. Well, that stifles trade. In fact, some traders might decide that it's not worth doing business at all anymore. So you'll consume fewer groceries and you might go to bed a little hungry, and their consumption of fewer widgets might mean that they have a slower computer. That is a lose-lose. So what's this mean to you as a real estate investor? Like I said, it's a push-pull. Tariffs often make for higher asset prices and consumer prices. That stokes inflation. Think about how that's bad for your tenant. If they're paying 25% more for tariffed groceries, now they can't afford to pay you more in rent. Of course, we know that inflation is good for you when you're a long-term leverage fixed interest rate real estate investor. Your debt gets inflated away, which is that fifth of 5 ways that I like to say that a real estate investor gets paid. Inflation also boosts the price of your asset, which is very profitable for you when you're leveraged. With leverage, even a small rate of return becomes your large rate of return. So let's talk more about these current events and how they affect you as we tilt into a new year. I'd like to welcome a guest back onto the show today. He was last here with us 3.5 years ago. And, to me, he's a truly special guest and a fantastic real estate teacher. In fact, he is the co-host of the first real estate investing podcast that I ever listened to, The Real Estate Guys. And he's had a substantial influence in my life. I'd like to give a big Get Rich Education welcome back today to Russell Gray.
Thanks, Keith. It's awesome to be here.
Russ, interestingly, at around the same time, I was at a real estate investing meetup in San Diego while you were at the IMN Single Family Rental Conference in Scottsdale, Arizona. And yeah, there's just so much happening in real estate today. And I think when it comes to current events in real estate investing, the word of the year could very well be affordability. What are your thoughts?
Well, yeah, definitely. Even though you have good employment or allegedly high employment and you have potentially rising wages, at the end of the day, the cost of living is going up just enough faster, especially when it comes to rents, that it's really challenging for people. And now you got rising interest rates for the home buyers. And so that creates an affordability issue. Of course, pricing goes up based on the bid. You got people out there trying to get into the properties, and then you've got their ability to pay for it. So I always say supply and demand and then capacity to pay. And I always break out capacity to pay as a separate item.
Right.
Just because somebody wants something, I mean, if you're crawling through the desert and you're dying of thirst, you might be willing to pay everything you own to buy that bottle of water, but if there isn't a bottle of water, that's fine. If somebody has a bottle of water and you've got no money in your pocket, it doesn't matter how badly you want it or what you would be willing to pay because you don't have any capacity to pay. So people's incomes and real wage growth versus the cost of living is a big part of it. Taxes is a part of it. Cost of energy is a part of it. And interest expense is a part of it. So those are kind of the three things that I pay attention to from an affordability standpoint. So it's not just pricing. A lot of times people think, oh, the price is unaffordable. Prices can go up if interest rates go down, if taxes are down, if wages are up. Then people can afford it. Then even though the price is going up, that doesn't make it unaffordable. It's a relationship between somebody's ability to service either rent or a monthly mortgage payment versus the cost of the property that really is what dictates affordability.
Yeah, exactly. When a lot of investors think about affordability today, they think about the fact that prices are up and interest rates are up. And that's definitely a headwind toward new purchases for their investing future. But yeah, you're bringing up the fact that, a lot of times as a successful investor, think about how your customer thinks. That's your tenant. And how does affordability affect them? And if their wages are not increasing at a rate faster than you can make rent increases, that can cause problems for you as a real estate investor.
Yeah, well, Rent Cafe just put out a study recently, and they just looked at what the most common search terms for people looking for rental properties was. And the two most common terms were cheap and studio. And that tells you something. So even though, landlords have been feeling like, hey, the economy's booming and people have been able to accept these rental increases, I'm not a believer yet that there's a whole lot of affordability in the rental market as far as tenants go. So I think that people need to be careful about building in rental increases when they're projecting what they think they can do with a particular property, because I don't know that you're going to have the benefit of lowering interest rates to save you if you're running tight cash flows. So if you can't get the rents up and you can't refinance to get your debt service down, maybe there's some room in your other operating expenses, but those are the two biggies. Then you just need to be really, really careful. I still think that the marketplace going into 2019 is going to favor affordable markets, affordable property types, affordable price points. And so I agree with you, Keith. Affordability is going to be a big topic in 2019. Real estate investors are going to have to pay attention to it.
And of course, rising interest rates make it more difficult for your renter to go be a homeowner themselves and leave and vacate your unit. And interestingly, we're now squarely in an era, at least for the last couple of years here, of rising interest rates. And what's so interesting with these forces, both toward and against a real estate investor, is oftentimes rising interest rates are injected into an economy to both cool an overheating economy and to slow down inflation. But now potentially we have the specter of rising interest rates, but yet still having inflation that's relatively tame. So just talk to us from your perspective. What are your thoughts if we do have higher interest rates, and they're still at historic lows, even with these increases, versus relatively low and tame inflation?
Well, I think a couple of things. One is interest rates are coming up maybe to heating economy, but I don't believe that that's the case because to your point, at least based on the Fed's measurement, CPI, inflation hasn't been out of control by any stretch. In fact, just not too long ago, they were complaining it wasn't enough. Now that they finally have kind of hit within their range, they're bringing the interest rates up. So, that's one way of looking at it. But I think you could make the argument that the CPI isn't really a good indicator of what it's like on Main Street USA. I think real world street inflation is actually higher. I mean, if you look at things like rent, you look at things like healthcare, you look at things like energy, those things have been going up. I mean, gas has come down a little bit recently, and even interest rates have moderated a little bit. But I think really the rising interest rates has been more about moderating asset bubbles. You've got a lot of the cheap money that the Fed has dumped into the system over the last 10 years, and not just the Fed, but central banks all around the world. And a lot of that has manifested in asset prices. So bonds being bid up bring interest rates down, stocks being bid up, obviously, until the last 4 or 5 weeks, stock prices had gone up very high. Real estate prices in many markets have been good and strong, bringing up that affordability issue that we talked about earlier. So the interest rates, that's part of it. The other thing is we're at the tail end of what is getting close to being, if it hasn't already become, the largest expansion in U.S. history. Just the law of averages says that there's going to be some type of a pullback. And so if I'm the Fed, and I'm not, but if I were, just like a real estate investor should be thinking about having dry powder. So in the Fed's world, dry powder is the ability to lower interest rates to goose the economy again. Well, you can't lower them from zero. So you got to bring them up in order to have a place to back it down from if you have to add a little stimulus. So even now, they're beginning to slow down how quickly they're doing it, although the last Fed meeting was a little bit more hawkish than dovish, and I don't think the stock market responded very well to that. So I think the interest rate policy is a lot more about trying to softly deflate some asset bubbles than it is about cooling off an overheating economy.
Absolutely. And I'm totally on the same page about the CPI, the Consumer Price Index, being a pretty dubious measure of the true rate of inflation, the true diminished purchasing power over time. I think you're aware of the resource, shadowstats.com, and there's some other resources out there to show you how today's CPI is calculated versus the way the CPI was calculated in the 80s and 90s. And you can see that the rate of inflation as it was calculated back then can be double, sometimes even triple the CPI that's reported today. And of course, the government has reasons for wanting to report that a certain way and keep that number low. It's politically unpopular to have a high inflation number. We also have government entitlements that are tied to that CPI number. So they have a lot of reasons for keeping that low. One other very interesting thing with interest rates that I don't think a lot of people are talking about, because this is still a rather small effect, but we've actually seen rates on traditional things like savings accounts and CDs finally creep up. A 2-year CD, you might even see a 2% interest rate now. Well, what does that have to do with anything? Well, if you can just park your money in something deemed safe and actually get a yield on it now, it's a little bit less likely that people are going to want to invest in asset markets, and just a bit more likely that they're willing to park the money. So that might make it less likely that asset prices inflate.
Yeah, and I think the other thing that you're seeing is that people who want to be in the real estate space, many of whom have been on the equity side for quite a while, are beginning to shift over to the debt side. And so that tells you a little bit. It tells you that they're thinking that the prices may not be going up as fast, and there's a lot more risk to be on the equity side. They prefer to be on the debt side where they have some protective equity, first claim on income, and it's the borrower's balance sheet that kind of insulates the lender. And to your point, the yields are getting a little bit better. So, anytime you start tweaking interest rates, which is the cost of money, the bid on money in an economy, it affects everything that's going on. And the more a street investor, a real estate investor understands that, the more they can begin to think about how it's going to affect them at the macro level. And when I say macro, I mean things like their interest rates, maybe taxes, or some of their other inputs. And then also at the micro level, because there's things that happen in a specific area. There's certain areas that respond. In fact, you mentioned shadow stats, and I thought that was interesting. So John Williams does shadow stats. And so he goes back and he uses the same criteria, as you mentioned, that they used in the 80s and applies it to today. And it tells you that inflation is a whole lot worse than the government claims. And of course, to your point, they have a lot of reasons to want to do that because of the cost of living adjustments and all the entitlement programs. But there's another one. I think it's called the Chapman Index. Are you familiar with that one?
Yes.
So that one is geographic. And I think that one is interesting for real estate investors because this is where you take a basket of he picks a few hundred products and he prices them out in different geographies. And it helps you realize that prices are different in different places. And therefore, the cost of living and affordability actually varies from geography to geography. Now, if you're a stock investor, you're somebody investing in paper assets that are traded on global markets and the price is the same everywhere, that's only moderately interesting. But for a real estate investor, that's very interesting because all of a sudden it gives you an idea, because this is how your tenants are thinking when they're looking around and they travel and they go someplace. They're like, wow, the gas is a lot cheaper here and it's a lot cheaper. Groceries are a lot cheaper here. Wow. I mean, maybe I wouldn't make as much money, but I could live better because housing is less and all these other things, or taxes are less, all of those kind of things. So it's an interesting index to pay attention to.
Absolutely. We'll link that in the show notes to both Shadow Stats and the Chapman Index. This is really important to you as a real estate investor because you're borrowing and leveraging greater sums of money typically than your stock, bond, and mutual fund investor is. We're talking about the very cost of money with interest rates and the purchasing power of the dollar here with inflation. And yeah, the Chapman Index, of course, you have a regional inflation factor applied to you wherever you live. In fact, no two people, even living in the same neighborhood, pay the same inflation rate. If there's inflation on beef, that doesn't affect the vegetarian. If there's inflation on oil and gas, that affects a commuter more than a non-commuter. Russ and I are going to come back and talk about some more contemporaneous things in the real estate world, including the impact of institutional investors in real estate and how that affects you. You're listening to Get Rich Education. I'm your host, Keith Weinhold. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is author Kristen Tate. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Russell Gray, co-host of the Real Estate Guys radio show. Russ, I was recently at a real estate investing conference in San Diego while you were at about the same time at the IMN Single Family Rental Conference in Scottsdale. And there's really been a more substantial impact of institutional investors rather than mom and pop money, private equity firms coming in and buying real estate, a really fragmented industry, and they're trying to compete. So just talk to us about the impact that you see institutional investors having in real estate and how that changes the dynamic for everyday investors like us.
Well, it certainly does. Anybody that's been in the space, especially as they came on board after 2008, just saw them gobbling up inventory like crazy. And in the beginning, a lot of people were thinking they were stupid, dumb money, that they were overpaying, but they were paying a premium for speed and convenience. And they had, I think, a good belief that they, through operating efficiencies and cheaper access to capital and of course, the ability to move quickly, they could make up for what they were overpaying. So we saw that happen, and those people now have built up these huge portfolios, and they have really taken both kind of a Wall Street approach, which is a very sophisticated financial modeling approach. Then they've also taken a big business approach where they have tight business systems and metrics. When you're there at an event like that, if you've ever been to like a RIA club or something where you're around a bunch of mom and pop real estate investors that have a certain level of sophistication, most of them are trying to figure it out, and they're learning how to calculate cap rates and understand the transactions and how to use contract clauses and contingencies and all that. And then you've got these people that are just playing the game at a completely different level. Warren Buffett famously said, coming out of the 2008 crisis, if I could buy 200,000 single family homes, I would,
Right.
but I can't. And the reason he couldn't is because the amount of capital that Warren Buffett has to deploy to make it worth his while is just too big. There was just nobody making a market in 200,000 properties. But there's a lot of people out there that were doing what Warren Buffett wanted to do, but on a smaller scale. And they were buying hundreds of properties at a time or dozens of properties at a time, building up portfolios with thousands and thousands of properties in them. And so these guys are all there talking about where they're at in their business and where they see the market going. And some of the folks who weren't able to play at the very high level were winding down portfolios that only had a few hundred properties in it, selling to the guys who were still aggregating properties full of thousands. So you had both of them present, people that were unloading and people that were accumulating. So it's kind of interesting.
John Burns was a common speaker. He spoke at both your event and my event. He's the expert on demographic-based strategies for real estate investors. And when it comes to institutional investors, he said something really important to my group that he spoke to recently in California. He talked about how Blackstone and private equity companies have increased rents 4.5% in the last year. And think about it, they need to meet metrics and make dividend payments to their stakeholders. But at the same time, mom and pop landlords, they only raised the rent 2.5% in the last year compared to 4.5% for institutional investors. So really, what is the narrative there? It's that mom and pops are less likely to raise the rent because mom and pop investors are just more likely to say, well, hey, we've got a renter in our unit and we don't want them to leave, so we'll just keep the rent right where it's at. So I thought that was an interesting effect of institutional investors. I think one important thing to keep in mind, though, is this space, especially the 1 to 4 unit income property space, is still dominated numbers-wise by mom and pop investors, not institutional investors.
Yeah, by the numbers, absolutely. But the thing is, when you understand the way real estate prices are established through comparative sampling, it only takes a handful of properties in any geographic area in a 1 square mile. If somebody has a portfolio with several hundred or several thousand properties and they dump 5 or 6 of them in 1 mile radius, if they are don't wanters and they want to get out and they're willing to take a little bit, just like they were quote unquote dumb money coming in because they paid too much, they could be dumb money coming out by selling for too low. But that impacts everybody. So just like you were talking, because they're pressing the rents, they have the ability to pull the market up because they kind of set the comps as far as the renters. So they definitely have an impact. I mean, one of the reasons, like with the rents, I think that they can push the rents is because they have the ability through scale to have a bigger pipeline of tenants. Their marketing cost is less. So if they push the rent and they push somebody off the back of the bus, they have somebody else that they can put into that property much more quickly than, say, a mom and pop investor. When you do the math as a mom and pop investor and say, yeah, if I push this person's rent and they vacate on me, now I've got vacancy and turnover, the 2 most dreaded words in income property management. I'm going to have vacancy and turnover and whatever advertising costs it's going to take me to get somebody new in the property. And when I amortize that for that extra 2%, I'd rather be a little bit below those other guys. So I don't actually fault a mom and pop investor for keeping their rent a little bit competitive relative to the other guys because they can't play the game at that level.
Sure, if the mom and pop investor only has 10 units, they can't risk 1 vacancy as much as a private equity firm holding 500 or 1,500 units can. So these private equity firms, they have the ability to move submarkets through scale. Maybe if they're helping hike rent increases, well, that can be good if you're a mom and pop investor in an overall submarket. But potentially a bad thing is if an institutional investor is in a submarket and they sell a whole lot of properties. So just talk to us some more about the potentially deleterious effects of institutional investors on mom and pops.
That's the thing that we're really paying attention to right now. That's one of the reasons we went to the conference, because we knew when they were in the accumulation phase that they were driving prices up and they were making inventory scarce. And the question is, and Peter Schiff has been telling us this for a long, long time, whatever these guys get to the point where they're ready to exit their positions, they exit their positions. And the single family home industry has never really had these mega owners in the space. Nobody knows what it's really like when somebody like a Blackstone says, okay, we're out, we're going to sell 20,000 properties. Nobody really knows what that's going to do to the market. And you look at them pushing the rents, you think, well, are they pushing the rents because they're getting ready to sell? Well, if they're getting ready to sell, they're probably getting ready to sell to another investor. It's when they get ready to go take it to the streets. I don't think they're going to do that because just like anybody, it's the same reason everybody says China's not going to dump U.S. treasuries, because if they did, they would crash the treasury market and wound their own portfolio,
Right.
when you control that many properties. But I think every mom and pop real estate investor needs to pay attention. And personally, I hope they do it, because if they do it, then that means they drive the prices down and the deals get better. It's not going to affect the rents. What it'll do is it'll make the deals better. So in some ways, it would be nice if they would vacate. But coming away from that conference, I don't see that happening. I think people are in love with the space. I think more money is coming into real estate, not less. The ability for big money to make its way into single family homes, which has usually been too big of a barrier to entry logistically, those things are being cleaned up. And there's a lot of people out there making markets where properties can be exchanged a lot the way they used to be, like stocks. I always thought that would never happen, but I'm watching it happen. If houses end up becoming chips to the Wall Street gamblers the way stocks have become, then it's going to change the game a little bit. The good news is that there's still the inherent inefficiency in real estate. There's always going to be crumbs for guys like you and me to go out there and clean up, because there's always going to be things falling off of those big guys' plates. But it gets more difficult as these people are in any marketplace. It's one of the reasons that we are fans of syndication for people that are interested in doing that, because if they raise money and all of a sudden they're playing in a marketplace with 5 or 10 or $20 million, they're not completely out of the ballpark of being able to compete with some of these guys, because they're building a concentration of a portfolio in a marketplace. If you're just out there trying to buy one-off properties here and there in your own account, they're there, but you got to have great relationships with great boots on the ground teams. Keith, you and I both know from working with the people that are turnkey providers that are out there in those marketplaces, they got to turn over a lot of rocks right now to find a deal. There's just not deals falling out of the trees right now.
Inventory is thin and waiting lists are getting longer in some markets. One interesting thing that might help alleviate some of the inventory constraint is something that really didn't exist so much a decade or two ago, and that's the increasing emergence of the build-to-rent trend in single-family homes. A builder in going out and building single-family homes specifically with the intent that renters are going to occupy those homes rather than owner-occupants. In fact, just in talking with John Burns, I learned that in 2005, 9% of America rented a single-family home, and today it's 12%. Proportionally, that's 33% more in less than 15 years. So any thoughts on the build-to-rent trend in single-family homes and how that affects investors?
It was one of the hottest topics at the conference. And by the way, just a point of correction, John actually was there as an attendee. He didn't speak, which we thought was really cool, because here's a guy that is a big brain guru that should have been on stage, but he wasn't speaking. But he was there for the same reason we were, which was to learn. And one of the topics that was definitely everybody was talking about was build to rent. And ultimately, that's what happens when you've got an inventory problem. The solution is build more inventory. And when you've been able to push prices to the point where it's affordable to build, then people are going to step into that space. The challenge that builders have had, and John Burns has been writing about this for quite some time, is that, and of course, if you've been following the stats, you know that new home sales are down. Builder confidence is declining now after hitting a record high in the mid part of 2018. So now builders are recognizing that if they want to continue to build and keep their crews running, they have to build to who's buying. And the people who are buying are investors. We are becoming a renter nation. I think that's a reflection of the millennial generation seeing their parents get wiped out and real estate not having the same allure to them. It's a factor of them coming out of college burdened with student debt, which is kind of a new generational experience. So these kids just don't have the same capacity to be able to earn and save because they're servicing the debt. The job market is not what it was, although I think that's being improved. It's still got a ways to go, and there's just a ton of millennials. So you look at that, and that's really created a renter nation. You still have people that haven't recovered from what happened in 2008. We lost, I think, 10% of home ownership or close to that. And so a lot of those folks are still out there in the rental pool. Some people have figured out when you take out the long-term potential profit of owning, and some markets just don't appreciate that well. I think people are just like, hey, you know what? It's a better deal for me to rent. I know a lot of people who are active investors that rent their own residence because you can get a nicer home for a lesser payment and have your capital put into higher ROI investments. Kiyosaki's been saying forever that your home is a liability. And so if you look at it that way, I just think there's a lot of reasons why people are renting and why renting is increasing. And builders are responding to that need for rental property by building it. And that's a trend I think we're going to see continue in 2019.
Absolutely. I don't think renters are considered losers to nearly the extent that they used to be. In fact, I've said on the show here that I would consider doing a sale leaseback of my wife and I's own home as long as I could continue living in my home, but converting a mortgage payment to a rent payment for a lot of other reasons that I've described earlier. But now you and your co-host, Robert Helms, host what is perhaps the most special real estate event I have ever had the pleasure of attending. Every year you host the Real Estate Guys Investor Summit at Sea, and that's coming up again in just a few months. Tell us about it.
It's really kind of become our signature event. In the beginning, it was just, hey, let's all take a cruise together with a bunch of real estate investors and teach classes. And we did that for the first 10 years, and it was great. Robert and I and Bob and some of our providers, our team, we were the subject matter experts. We were the gurus. Well, after 2008, we decided that we needed to get smarter people on board. And so in 2012, we had Robert Kiyosaki come on board for the first time with his group. And he was a huge hit. And he loved it. He's been back 4 or 5 times. He's coming back again in 2019. The following year, Peter Schiff came, and he's been back with us every single year ever since. And Peter is best known for being the guy that warned vociferously on public media that the 2008 crash was coming. He called it in writing, he called it for the right reason, and he became quite famous. Since then, he said, look, everything that went wrong, we haven't fixed. In fact, we've made worse. And up until, I don't know, probably a couple months ago, everybody thought he was just a broken clock. But lately, Peter's been getting more press because, the things he warned about in Bitcoin, the things he's warned about in the stock market, and the Fed policy is starting to come true. So I've seen more of Peter Schiff on mainstream financial news because he seems to be the guy that is getting it right again. So Peter's coming back again. So excited to have him. Along the way, we picked up some other folks, Chris Martenson and Adam Taggart, who do Peak Prosperity. Chris is a PhD, super smart guy, scientist. He was a stock guy until 2008. And then he got wiped out or damaged very badly. And he, like me, was shaking his head going, I'm kind of a smart guy. I don't understand how I missed this. And so he began studying. He created a thing called the Crash Course, which millions of people have seen. And it's really about just being aware and prepared. And one of the unique takes that Chris takes is he focuses on energy and the environment and realizing that energy and the environment are finite resources. And when you have an economic model that requires exponential growth, it requires the exponential input of commodities and energy. And if those things are finite, then at some point down the road, there's going to be a convergence where you can't grow. And if you're not ready for that as an investor, and everything is based on exponential perpetual growth, then it's going to be quite shocking when we hit the wall. We talk about a lot of those high-level things, but we also have a whole bunch of niche experts. We got Gene Garino from Residential Assisted Living Academy. He's very successful in his space. Brad Sumrock in the apartment multifamily space. We have Bob Burr coming and talk about oil and energy. Brian London, who hosts the New Orleans Investment Conference, is an expert in gold. His buddy Dana Samuelson is there. So we talk about precious metals. So anyway, the point is we get a couple hundred investors together with a couple of dozen really, really big-brained faculty members. And we talk about high-level stuff. We get together and we talk about tactical street-level stuff. We look at what's going on in the world, what's going on in real estate, and all the peripheral economic things. We look at it from the top down. We look at it from side to side. And in 10 days, because that's how long we're together, 9 days on a cruise ship, we cover a lot of ground. It's like going to summer camp. When you were a kid, you go to summer camp and you get there and you're in your cabin with a bunch of strangers. And by the end of the week, you're best friends for life. Yeah. And that's what happens. And so you get more done in relationship building and financial understanding and growth in 10 days. And most people get done in 10 years. And it's just a ton of fun. We're going to go to Bahamas, Grand Cayman, Aruba, Curacao. We're sailing out of Fort Lauderdale, Florida. It all takes place March 15th through the 24th. All the details are available. If you send an email to GRE@realestateguysradio.com, GRE like Get Rich Education at realestateguysradio.com, then I'll send people links to that and other stuff that we do, and they can find out all about it. Kiyosaki came to us this year and he says, guys, I want to do something special this year. I want to bring Tom Wheelwright. I want to bring Andy Tanner. I want to bring my team, and I want to talk about infinite return. Robert really feels like going into 2019 that people really, really need to understand how infinite return works, how you can invest without a lot of money or virtually no money in a deal. I mean, you might have a little money to start with, but how you get it all back out, sequester your capital, and yet go forward with a positive ROI on nothing, which makes the return infinite. So he's going to be breaking all that down for us too. Keith, I got to tell you this. 2 years ago, we did Robert Kiyosaki's 70th birthday party, and it was just a ton of fun. Last year, we did his 71st birthday party, and that was a lot of fun. This year, the Friday night before we get off the cruise ship, or the Saturday, whatever night it is, the last night of the cruise ship, when we do our big party, it is the day of Peter Schiff's birthday. So we're going to throw this epic birthday for Peter Schiff. In fact, we set up a schiffbirthday.com so people can come. So it's just, I mean, well, you were there last year, so you know how much fun we have.
Now, almost every one of those names Russ has mentioned has been here as a guest on Get Rich Education, and you can actually get around these people. There is no other comparable event I know of like the Real Estate Guys Investor Summit at Sea. As a Summit alum myself, I would know, and I really can't recommend it highly enough. And if you want the opportunity to not just meet Robert Kiyosaki and shake his hand, but for example, it might be 4 of you. It might be you, Robert Kiyosaki, and 2 others just sitting around a dinner table for an entire hour. I mean, really have conversations and really get to know each other. There are just exceedingly few places on the globe where you can get around all these names and do that. And at the end, it really is like summer camp where people have tears in their eyes and they're emotional that the entire thing is over after about 9 days or so. So I don't know of anything else like it. If you want to learn more, I really suggest checking it out and just at least finding some more information out about it at GRE@realestateguysradio.com. Russell Gray, any final thoughts?
Keith, it's just fun looking at what you've become and all the good you're doing in the world, sharing your good ideas. Super proud of you. I hope that your listeners will come out and hang out with us on the summit. It's a ton of fun listening to the panels and watching all these really smart people talk to each other like a fly on the wall, and then being able to have a drink with them and have them explain to you what they were saying. I mean, it's epic. So thanks for being a financial educator. Love being a part of it. Thanks for having me on the show today. Appreciate it.
It's been great having you back. With current events, Russ and I touched on a number of larger economic factors that are out of your control. Okay, so that factor is out of your control, but how you respond is still very much in your control. Speaking of factors more in your control, this week we've been talking about larger picture factors, but next week I'll be with you to discuss specific actionable tactics that you can take to reduce vacancy and turnover in your properties, which, as we touched on today, is your greatest expense. Next week, we'll discuss how you reduce that expense. As great as the Investor Summit at Sea Cruise is, it is not a cheap, low-budget event. You'll pay a healthy price for a ticket for yourself, and a lot of people bring their families along and make a great Caribbean cruise vacation out of it for them. But the fact that it's not a cheap event is also good. People that show up are high caliber, and they take real estate seriously. As I like to say, it's not cheap, and neither are you. You are worth it, believe me. I think attending the Investor Summit at Sea is close to the very definition of investing in yourself. Here's the interesting thing. Robert and Russ, the hosts of the summit, they don't pay their speakers one dime. All of these high-level speakers are paid nothing. The event is elite with the quality of the person that attend, people like you, that the speakers speak for free because of the environment that's been created. And that's a good thing, because if they had to pay the speakers, then you'd probably have to pay hundreds of thousands of dollars or more in order to attend. It is a floating conference with breaks for networking, breakout sessions and workshops aside from the general sessions. And the fact that you're all on the same cruise ship, it gives you this proximity and this collective that's just hard to replicate anywhere else. It's like you get to meet with members of your own personal advisory board that entire time. And all that's not even to mention the great island excursions that you'll go on when the cruise ship is in port, if you wish. So imagine meeting like-minded friends. You'll probably gravitate toward a few interesting people, and they to you. And then you might snorkel Grand Cayman Island together or do a van tour of Aruba together. Again, the cruise begins in Fort Lauderdale, Florida, and the cruise destinations are Grand Cayman and the Netherlands Antilles. The Netherlands Antilles are also known as the ABC Islands because they're Aruba, Bonaire, and Curacao. They're the ones far south in the Caribbean, quite close to South America. I would know about all of this because I have been a summit attendee myself. It's coming up soon, March 14th to 24th. I've long enjoyed listening to Russ. He's been quite an influencer in my life. And just to put it plainly to you, their summit attendance keeps growing year after year, but they would still rather have more people attend their summit rather than fewer people. So it would make me feel great, and it would make me feel like I'm giving back to them if you considered attending, and it would probably be the best investment that you make all year. And you can do that by simply sending an email to an address that's also in the show notes. It is gre@realestateguysradio.com. Until next week, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
As America's third largest city, Chicago, Illinois has big economies of scale for real estate investors. But there are problems with investing in highly taxed, fiscally strapped Illinois. You can beat it when you invest in Chicago land, staying on the Indiana side of the state line. Your property tax on a median Indiana home is less than half that of an Illinois property. Forbes ranks Indiana as one of the top 10 states to do business. With typical rents at $1,250 and purchase prices at $125K, Northwest Indiana numbers work. Learn more and connect with the turnkey provider at getricheducation.com/Chicago. That's getricheducation.com/Chicago.
71% of Americans aren't saving enough for retirement. It's going to get worse as people live longer, and you need to start thinking differently. But you can't lose your time. Real estate is the investment vehicle that's made more ordinary people wealthy than anything else. Keith Weinhold of Get Rich Education is host of one of America's top investing shows, Disrupting Wall Street. He's an international best-selling author, a writer for Rich Dad Advisors, and has been an active income property investor since 2002. He has created thousands in passive monthly income for countless followers, and now he has a free book, The 7 Principles for Creating Wealth in Your Life. Get your copy now at getricheducation.com/book. That's getricheducation.com/book. Because invest in what produces income for you now and later. Sign up now at getricheducation.com/book.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.